Welcome everybody to the second installment of our Fear and Greed live recap webinar. I'm Alex Thomas, Research Manager on John Burns Research and Consulting. I'm joined today by my colleague Chris Nebenzahl. I'm super excited that he can be here. Chris is our VP of Rental Research on the John Burns Research and Consulting team. So I'm going to go through the live recap of our Fear and Greed survey, some of the results, some of the quarterly questions that we asked. And then I'm actually going to pass it over in the second half here to my colleague Chris, who's going to do a bit of a deep dive on the apartment space. So some really interesting trends going on there. We've got a wealth of data that we can pull from. So really excited to have him go through some of that live as well. All of our contact info is down there as well, so feel free to reach out to us after. You will get a copy of the slides, and we are going to keep this pretty brief today. We're going to try and shoot for around 30 minutes. Feel free, if you have questions, feel free to put them in the chat, and we'll try and get them answered towards the end. So we'll go through it. Before we start, just in case you don't know who John Burns Research and Consulting is, or JBREC, we look at real estate from every angle. So this is a pie chart that we always like to show of our clients. We focus mostly on the housing, the residential side of real estate. We do touch all areas of real estate in some way or another. And we're big fans of trying to get different parts of the industry to come together. So we've got conferences, we've got live webinars, we've got client exclusive events, and we always try and get a good mix of our clients talking to each other. So I think that's something special about us. We also look at real estate from a number of different angles. So we've got a top-down approach. I sit on our macro team, so this is really where I like to live, looking at all the economic data, all the housing data, all the other real estate data out there, and using that to inform our view, our thesis about what we think is going to happen over the next several years. And that's really the research side of our business. And we've also got kind of this bottom-up approach as well. We've got our consulting team who spread all across the country. We've got experts in every market, every major market across the country. And they're really our boots on the ground. They're going out, they're doing market studies, they're doing feasibility work, talking to our clients, talking to real estate developers, builders. And they're really our boots on the ground team that informs our view as well. We've got a huge amount of proprietary data, and in particular, we have a ton of proprietary surveys as well, including this one that I'll walk through. We really find that the proprietary survey work that we do tends to lead a lot of the hard data that comes out, so we put a big emphasis on the survey work and getting a sentiment read on the industry. And then lastly, like I said, we do have those client exclusive events. We love getting our clients together, talking to us, talking to each other. So a lot of really fun things that we offer there. We also, like I said, we do a ton of survey work over there on the left. That's just a sample of some of the surveys that we run, including our Fear and Greed survey here. Those are business to business surveys. We also do business to consumer survey insights. We survey build to rent residents. We survey consumers. We survey architects. We also track earnings calls across the industry. We've got a massive database of data both that we purchase as well as data that we collect ourselves. And all of that's experience. You can experience all of that through our interactive dashboards platform too. We have a ton of sector level and market level reports as well, doing deep dives on industries in specific areas or in specific sectors. And then, like I said, we do have those client exclusive conferences and webinars. Going through the results really quick. So we just wrapped up our third quarter of 2025 Fear and Greed survey. This is a commercial real estate survey that we do, of course, in partnership with CRE Daily, as well as our sponsor InvestNext. The most recent one came out here just in the middle of September, so responses are pretty timely here. Really interesting time in the commercial world right now. A little bit about the survey. The goal of our survey, as with all of our surveys that we do, is really to get a timely indicator of commercial real estate investor sentiment, as well as their expectations. We put a big emphasis on forward-looking indicators in all of our surveys, because again, we find that tends to lead there's a lot of great hard data out there, but it tends to be a little bit lagging. Very diverse sample as well. Over there on the right, you can see the different roles of the participants across the survey. A lot of owners, some operators, GPs, LPs, brokers, and some that don't fit neatly into any of those categories. We tend to get between 500 and 1,000 market ratings every single quarter, so really, really great sample size. Most recent survey period, again, was early September, late August here, and we cover about 4 commercial real estate sectors primarily. So we focus mostly on multifamily, industrial, retail, and office as kind of those core 4. Our sample is also very geographically diverse. So we survey all across the country. We do skew a little bit more towards the larger operator, developer, owner side. Most participants are on that large to very large scale. So a good read on the institutional on institutional players. So getting into the data. So our overall fear and greed index is at 56. So what does that mean, right? So our scale goes between 0 to 100. 100 is maximum greed. That's probably on that irrational exuberance side of things. And then 0 is maximum fear. 50 is stagnant. So that's right in the middle. That means that the market is neither contracting nor expanding. Right now, we are pretty close to that stagnant range. I think no surprise given where rates are, given what we're hearing across the industry about activity. But we are, especially in some sectors, starting to see us creep more towards that expansionary side. So multifamily and industrial and retail actually above that four sector average. Office bringing up the rear, but office even at 51, so slightly above that middle line there. That's the first time that we've seen a number above 50 in office in the whole time that we've been doing our survey for about 2 years now. So what is our index? Again, a healthy market here is probably between 70 and 90. We want the majority of participants to be looking towards expanding their investment exposure to commercial real estate. Our index is driven by primarily three indicators. We ask about their current investment strategy. So did you in the most recent quarter increase, hold, or decrease your investments in commercial? And then also, what do you expect to do over the next 6 months? So again, that forward-looking piece. And then lastly, we also ask about access to capital, really the rate limiting factor, I think, in most of the commercial real estate world right now. We ask about whether it's getting easier or harder to access in the current quarter versus the prior quarter. So kind of trying to tease out the direction of travel there for credit conditions. So our investor sentiment survey, our overall index has been flat for about the last year and a half. We did technically get the highest reading this last time, but it's remained remarkably similar over the last year. You see a little bit of an increase back late in the back half of last year. I think some of that was predicated on some of the optimism given the rate cuts that we got from the Fed in the last part of the last year, but not a ton of movement in our overall index here. When you break that down into some of the components that make up this overall index, I think the biggest piece right now is this current exposure piece. 71% of commercial real estate investors are holding tight. They're neither increasing nor decreasing their investment exposure. So not a lot of green on this chart, also not a lot of red on this chart. So that piece that section of investors who are neither increasing nor decreasing their exposure has continued to grow over time. So we're at about 71%, not changing right now. It's the widest that gap has been in our survey's history here. Like I said, access to capital is still the rate limiting step for commercial real estate expansion. You've still got more investors saying that capital is getting harder to access versus getting easier to access. And that's that red versus that green on this chart. The good news, though, is that things are moving in the right direction. So this is our index value, which is essentially just looking at the ratio between those who are saying the capital is getting harder to access versus easier. And you do see that the direction of travel is positive here. So we are still in that below 50 territory, but especially in some sectors, that retail, industrial, we're getting close to that 50 range. And that's been a pretty consistent trend across all of the sectors that we track over the course of our survey's history. So I wouldn't be surprised to see this flip positive maybe next quarter or the quarter after if things keep moving in the right direction. One of the great things about our survey as well is that we are able to ask some pretty unique questions every quarter. So we always leave some space in our survey to ask things that are timely, that are topical. And so one of the questions that we asked this time was, all right, what are typical cap rates in the sectors that you operate in today? No surprise that office is the highest on this list, around 8%. The other sectors between 6 and 7. But I think the more interesting question that we asked was the follow-up. So we got that base cap rate for right now. We also asked, all right, across sectors, what cap rate would you need to aggressively deploy capital in the sector that you operate in? And so across sectors here, you can see that yellow dot is that number from the previous slide. Pretty much in every sector, investors are going to generally need about 100 basis point increase in cap rates to really consider aggressively expanding in their particular industry. Now, if we did see something like that, what that would tell us is that would probably imply about a 10 to 15% drop in asset values. The good news is investors are not expecting that anytime soon. So one of the other questions that we ask is about expected change in asset values over the next 6 months. We actually saw an uptick across every single sector that we look at. Industrial at 3%, retail at 2%, multifamily at 1%, and even office down there is is a zero, right? So that's investors saying that we don't expect any change in asset values over the next 6 months. So no growth, but definitely an improvement from where office has been. You can see just last year, that number was closer to -4, -9 earlier in 2024. But I think this is good. I think this tells us that, all right, maybe office values have bottomed out. Of course, this is going to vary a lot by the type of property, of course. Class A trophy office is doing a lot better than some of that Class B, Class C. But when we're looking at the sector as a whole, I think we can say that potentially office values have bottomed based on what we're hearing from investors. Now, again, we don't expect those declines. We don't expect those cap rates to increase. What that does tell us is that activity is probably going to stay muted in the near term. So we also ask investors, do you expect to increase, do you expect to decrease, or do you expect to hold your exposure to commercial real estate in the near term over the next 6 months? Pretty consistently in our survey, that share who expects to just hold on tight is larger than that share who expects to increase their investment exposure. So not a lot of movement here. When we look at the sector breakdown here, you do see that multifamily and industrial investors, the most optimistic in the near term. Industrial has been pretty high on that list for a while. Multifamily also pretty high in that list. Fundamentals are quite strong in that sector, as Chris will go through in a little bit here. We did see the largest quarter-over-quarter decline in the retail space, and I think that's no surprise there. Last quarter, we asked some topical questions about tariffs, about goods inflation, and we did hear some concerns from the retail groups, from retail investors. And I think you're seeing that continue here, especially as we get concerns about the labor market outlook, as well as the general trajectory of trade policy and goods inflation. Office, though, like I said, moving up. I think the theme here is that office is conditions in that office space are improving. The truth of the matter is, though, the interest rates on long-term debt are still too high for a lot of deals to pencil. That's the theme across really most of the surveys we've done over the last year, but it's still coming through quite strong. At the end of our survey, we always have a text box where we ask investors and we ask participants in the survey to just tell us anything that they want us to know about what's going on in the space. And we got a ton of different quotes. This is just a sample of them, and I'm not going to go through all of them. Talking about how the 10 years still too high, long-term rates are still too high, just not a lot of deals penciling right now. And also some doubts that lower short-term rates and potential rate cuts from the Fed will actually lead to lower long-term rates, which I think is interesting. We actually asked a question along these lines as well. We said, all right, the Fed cut rates last year about 100 basis points. If the Fed did another 100 basis points of rate cuts this year by the end of the year, which sector do you think would benefit the most from that Fed funds rate cut? And the answer was overwhelmingly multifamily. Actually, more than 50% of investors believe that multifamily would be the biggest beneficiary of Fed rate cuts. Second place here is that none category, saying that 100 basis points isn't enough of an interest rate reduction to drive that significant influx of capital. So why is this? Multifamily relies more heavily on short-term debt. Short-term debt tends to be more closely tied to that secured overnight financing rate. That's the rate for short-term debt, right? And that tends to move in lockstep with the federal funds rate. So the orange here is that SOFR rate, and green is the federal funds rate. You can say as soon as they cut rates, that SOFR rate tends to move with it. So I think that's why we're seeing the optimism for multifamily in the short term here. Beyond just the financing piece, though, I do think that fundamentals are quite strong for multifamily. Like I mentioned, we also have a demographics team internally. They've done a lot of great work looking at households, both owner households and renter households. One thing that we've seen is some really strong growth in the number of U.S. renter households. So you can see that green bar is quarterly, that line is the trailing 4-quarter average, but that's growth in renter households over time here. So a lot of strength, especially relative to the last several years, pre-2024, a lot of strength in renter household growth. The reason behind this, no surprise, the for sale market is very expensive right now, especially given where rates are. We've seen mortgage rates come down just a little bit, but that affordability calculation is still pretty out of whack. Right now, the cost to purchase a home versus renting that same home, that purchase premium line over there is about 95%. So about double the cost to own a home versus rent that same home right now. No surprise, right? You've seen apartment turnover fall at the same time, especially in 2022, starting in 2022 when the Fed started raising rates. You can see that poor for sale affordability really is keeping renters renting for longer. You see this in some of the commentary from the apartment REITs out there who are all saying, move outs to home purchase is pretty low right now, at least relative to historical standards. So I think a lot of great fundamentals for the multifamily space. So that I'm going to go ahead and relinquish control here over to my colleague Chris Nebenzahl, who's going to walk through some of our great data on the multifamily space.
Awesome. Thanks, Alex. Excited to be here today. Excited to be talking about multifamily. And Alex really kind of gave a great foundation for where we're thinking about the multifamily industry at this point in 2025. So I would say we're very much cautiously optimistic. We're not overly exuberant. We're not all the way on that 100 scale for the greed. But we're also not, still feeling the pinch that we've been feeling in multifamily for a while. For multifamily, we saw rents shoot through the roof. Demand was high, occupancy was high, and as a result, you see the starts accelerated significantly. So starts you see here, both for multifamily and BTR. In 2022, 2023, but those 23 and 2024 falling even further. Interestingly enough, we've been observing this BTR trend, the build to rent trend, and it's taking a large multifamily. So when I say multifamily, I'm talking about mostly professionally managed apartments or build to rent. And when you look back to, say, 2016, build to rent really didn't exist much at all. By 2018, it was about 3% of the overall multifamily starts. It's now up to about 10%. So when I talk about multifamily, it's not just institutional grade apartments anymore. The build to rent segment is really having a material piece of that overall multifamily environment. As Alex mentioned, we're seeing really strong rental demand. Our demographics team put out their rental demand and renter household formation forecasts, and you see this strong demand playing out in apartment absorption. We're well above the historic apartment absorption rate, meaning the number of apartment units as a percentage of the total apartment inventory. Typically, the average rate is about 2.5%. We're well above 3.5% at this point. Same thing with the absorption to start ratio. That looks at the number of units being absorbed every quarter compared to the number of units started every quarter. And we're at about 1.6, which means we're absorbing 1.6 units for every unit that's starting. Now, we're still in a fairly balanced position for deliveries, and we still have a lot of lease-up inventory. That last slide I showed you, all the construction starts from 22 and 23. We're still working through a lot of that, but if we continue to see this absorption to start ratio well above 1, we should see occupancy continue to accelerate. We should be back in a position of pricing power for apartment owners and operators, likely by the end of next year into 2027. Certainly that's market dependent. The Sun Belt has been hit a lot harder than the Northeast and Midwest has for supply. But again, when looking at the national level, we're expecting to see more of a balance mid to late next year and pricing power return for rent growth in 2027. So again, if demand is strong and supply has come down, why aren't we seeing rent growth? Well, these are a number of quotes from the public REITs as well as main industry press. Pre-stabilized properties limit overall multifamily growth. That's from CBRE. Multifamily oversupply drives down asking rents. We've seen uncertainty and higher leasing pressure, particularly, impacting the leasing velocity in our lease-up portfolio. There's a ton of supply currently in lease-up. And so even though we're past peak supply, we're far past peak starts, we're past peak deliveries, all of the properties that are still in lease-up, still offering fairly significant concessions, keeping that rent growth low and keeping that overall occupancy number low as well. So I mentioned overall occupancy. That's the total occupancy that you see here on the green line. Stabilized occupancy, occupancy in any property with 85% occupancy or higher. Stabilized occupancy is pretty good, 94.3. Typically, that's around 94.7, 94.8. And again, you see the big run up in 2021. You see the slowdown. But that stabilized occupancy started to grow. The total occupancy and really the what's shaded in here in purple, that's what is in lease-up supply. That's the gap between stabilized occupancy and total occupancy. Total occupancy not really growing, except for maybe a little bit in the second quarter this year. Again, that's a good sign. I expect that to continue. I hope that continues. And I hope this gap between total occupancy and stabilized occupancy continues to contract, because that means we'll be back in a position of pricing power and a position of stability, again, likely next year and into 2027. This is that same data just presented differently. This is the total number of vacant apartment units in the United States. So you see, really since 2022, that number has skyrocketed to well above 1.1 million total vacant apartment units. Now, if you want to call a few months a trend, and I would say that's perhaps the beginning of a trend, as we've seen deliveries start to slow down, as we've seen absorption remain strong, I would want to see this trend continue through the remainder of this year into next year. And that's really what's going to drive us back to that stability, back to that equilibrium level where we can start driving rents once again. This is our rent growth, rent growth for all three rental sectors that we track. So this shows our apartment rent index, our single family rent index, and our build to rent index. So apartments, you can see the green line really had the highest peak, but also some of the lowest lows. It tracks fairly similar with build to rent. Build to rent being purpose-built single family homes in a community of at least 25 or more. Our single family rent index looks more at the scattered sites. So the Invitation Homes, the American Homes for Rents of the world, where you're renting a home one-off, not in a purpose-built community. That industry does have a few of the large REITs, as I mentioned, but it's really dominated by mom and pop owners, mom and pop landlords. And so you don't see as volatile swings in the rents. The highs were not nearly as high in 21 and 22. The lows were not nearly as low as they were over the past couple of years. But BTR, which is generally professionally managed, apartments certainly generally professionally managed, they track one another fairly similarly. So you see this green and the blue line bumping right along flat. It's not really until 26, 27, 28 do you see us return to that normal level of 2 to 4% rent growth at the national level. Now, again, I mentioned that all of this is market driven and regionally driven. Markets like Austin, Denver, Phoenix, Dallas, those rents have gone negative and remain negative on a year-over-year basis. Boston, Chicago, San Francisco, Columbus, Pittsburgh, those rents have been positive and continue to trend positive just because they haven't had as much supply, don't have as much lease-up pressure going on right now. But what gives me encouragement, what gives me real optimism for where we're headed, is where we see income growth in relation to rent growth. So if you look back pre-COVID, income growth and rent growth basically were right on top of one another. They tracked very closely. Now the pandemic hit and incomes remained steady, rents fell immediately. And you see, for the better part of a year, rent growth was significantly lower than income growth and overall wage growth. Then you see kind of demand shoot up in 2021. You see rent growth just soar past where income growth was. All of the area in this light blue shaded area is when rents were going way higher than incomes. We certainly saw that in the mainstream media. Rents were growing. Affordability challenges on the rental side really hit hard. And then you saw rents start to come down, 2022, 2023, into 2024, but incomes remained fairly steady. So if you look at the total area shaded in purple for both of these batches, and the area shaded in blue, otherwise described as kind of the compound annual growth of both metrics, it's pretty similar. Rent growth on a compound annual growth rate basis over the past 6 years is slightly higher than income, but that continues to narrow. And while we expect to see basically flat rent growth for the rest of this, fairly tepid rent growth next year, we do think incomes will outpace rent growth for another year or so. You'll see that compound annual growth rate basically line up with one another again. And that also coincides 2026, 2027, when we once again get pricing power on the rental side. So I see the apartment industry, the multifamily industry, really coming back into kind of an equilibrium over the next 12 to 18 months, really back into balance. And this is not what a typical rent growth chart looks like. The supply chart I showed you is not what a typical supply chart looks like. I really think the last 5 years was one of the most volatile periods in multifamily, and likely the most volatile period that we'll see for quite a long time. If we really go back to the basics, pre-COVID, even pre-GFC, multifamily is a very slow and steady industry. And I think we're just returning to that steadiness and that stability likely next year and beyond. Now, I do want to talk a little bit about the transaction market because I'm noticing an interesting trend. Like I said, the Sun Belt is, I'd say, very soft in terms of fundamentals. Occupancy is lower, rent growth is weak, negative in some markets. And yet the REITs, the biggest institutions, are basically pricing the Sun Belt at the same cap rate where gateway markets are. In certain situations, the Sun Belt markets are trading tighter than the gateway markets, which has almost never happened. You see folks like Equity Residential, they're looking at their expansion markets, Atlanta, Dallas, Denver, looking at, selling high fours, low five cap rates. Avalon Bay, Sunbelt metros in the high 4 to 5% cap rate range. Same thing for the gateways, you're seeing, mid fours to 5% for San Francisco, for DC, for Boston. So for the first time, the Austins and Dallases of the world are trading right in line with the San Franciscos and New Yorks of the world. And I think that, excuse me, I think that represents a monumental shift in where capital is headed as we move into the next cycle. I think you'll see a lot of capital flows into the Sun Belt. They see the recovery starting to take place. They see the strong absorption, even though the fundamentals aren't here today. You'll see more and more growth in those Sun Belt markets. And finally, Alex talked a lot about what 100 basis points would do for any of the commercial real estate sectors, but certainly for multifamily. I just kind of want to walk through where we've been with forward implied SOFR rates. And so if we look really where we were a year ago, we were expecting the Fed to cut significantly and that SOFR would already be around 3%. Now, if we look in March of this year, there was the tariffs, there's the rumors of the tariffs, there was all sorts of uncertainty starting to build. And so everyone said, wait a minute, I don't think the Fed's going to cut quite as much. We still see a flat forward SOFR curve, but significantly higher, about 80 basis points higher than where people were predicting in September of 2024. Then we move to June of this year and we start to see more economic uncertainty. The tariffs are starting to have an impact, perhaps some murmurings about job softness, and you see that more slanted, more sloped SOFR forward curve, implying that the Fed would have to start cutting rates once again. And then you get to where we basically are today. This was from 2 weeks ago. And in one trip around the sun, we basically made it back to the same place we were for forward SOFR at the end of next year, meaning the market now implies another 75 to 100 basis points of rate cuts.
All right. Well, Chris is frozen on my end, so I'm going to jump in a little bit here. But I think the point's taken, right? We've changed a lot in the last year. And I want to wrap up with a couple key takeaways. So we always like to end our slide decks on, what's actionable from our takeaways here. I think the key theme for CRE investors right now is that we're in wait and see mode due to elevated rates and uncertainty, and I think we're going to stay that way until long-term rates come down. Again, maybe we get some more Fed rate cuts this year, but a lot of investors at least telling us they're not expecting a lot of movement in that long-term, that longer-term end of the curve here. All right, so what are the takeaways at the sector level? For multifamily, I think there's some optimism, right? I think investors are telling us that we may realize some tangible benefits from lower short-term rates in the near term, as Chris was pointing out. And as we know, multifamily is a bit more dependent on those short-term rates than some of the other sectors. So I do think there's potential upside there. On the retail side, I do think that we saw that sentiment dipped more than any other sector, and I think that's some holdover effects from the impacts of trade policy changes earlier in the year, and then lately we've seen some weakness on the labor market front as well. And so I do think you may continue to see that contract, depending on what the employment data going forward looks like here. Industrial is the most resilient CRE sector right now. Investors are expecting 3% asset value growth in the next 6 months. I'll remind everyone that last quarter we also asked a couple of questions specific to the industrial sector, to industrial investors asking about potential impacts of trade policy. And for the most part, industrial investors were fairly optimistic. Office, also some positive stories there. We do think that values may have bottomed and investors are no longer expecting asset values to decline. So I think office still the weakest of the 4 sectors, but I think potentially on the upswing. And again, lots of variability across all of these sectors, depending on the type of property, right? Class A, B, and C. So what are some opportunities? I think that poor for sale affordability is still supporting healthy demand for multifamily going forward. Chris was showing some data around absorptions. I do think that we are seeing some strength there, especially as we move past we're still in that peak lease-up period. We're past peak deliveries, but I do think that there is going to be some more strength on the multifamily side going forward. Again, office still on the upswing, especially those high-quality properties. And I do think there's some distressed opportunities available as well. We got a couple comments around these lines that there are some bargain pricing deals out there right now, depending on where you're at. And I always like to end on this quote because I think it ties well nicely to our general title for our fear and greed survey here. To be greedy when others are fearful. There's always opportunities in different markets to get in or get out, depending on what you're looking at. Just want to close on a couple different notes here. How can you access the full survey results? We'll send the slides out, but you can also access the full report via the CRE Daily website, or it's also on the JBREC website. Feel free to reach out to us if you can't find it as well. We're happy to send them to you directly. The links are right there as well. Where can I get future surveys sent to my inbox? Well, you can sign up both for CRE Daily's newsletter. It's also a great way to stay on top of commercial real estate investment trends. You can also subscribe to the John Burns newsletter as well. So we do analysis 1 to 3 times per week. We focus a bit more on the residential side, but we do release some commercial real estate and some multifamily analysis as well. And then how can you participate in future surveys? If you want to participate in the Fear and Greed survey, we would love to have you participate. If you already participate, thank you so much. You can sign up you can sign up for CRE Daily's newsletter. Every CRE Daily subscriber gets emailed a link to participate in the survey. If you have not gotten that link, feel free to reach out. We'll make sure that you're on the email list for the next one as well. We also have some surveys for John Burns as well. If you're interested in participating in the John Burns surveys, I'll let Chris give a little teaser for how to participate in these as well.
Absolutely. And thanks, Alex. Sorry, I think I cut out there briefly, but I appreciate it. We do have two proprietary surveys within John Burns focused specifically on the multifamily world. One is our apartment developer and investor survey that runs quarterly. We also run a quarterly build-to-rent developer, operator, and investor survey. So if you are in either of those sectors, if you're interested in participating in the survey, please reach out to me, reach out to Alex, and he can connect you as well. But the survey focuses on a lot of, as Alex mentioned, kind of those forward-leading questions that we're able to glean really interesting insight from. Anyone participating in the survey gets access to the survey, whether or not you are a John Burns research and consulting client. You also get access to one market and the apartment data or the BTR data behind that market if you're interested. So our clients get access to all of our surveys, but even if you're not a client, you would get access to any survey that you participate in. So if you're interested, we would really appreciate more participants in these surveys. Please reach out to me, please reach out to Alex, and we would love to have you.
Awesome. Thanks, Chris. Yeah, all of our contact information is up there. Feel free to reach out to us. Thank you also to our partner, CRE Daily, for helping us drive the sample here. Thank you also to our sponsor, InvestNext, for helping us drive a great survey every quarter. Again, we'll send out the slides and feel free to reach out with any questions. Thanks for being here, everyone.